You guys want to know my favorite way to purchase a property, and it's not by using a bank. Seller financing is the best way, and this is how it works. Seller financing is when the original owner of the property acts as the bank. Instead of the buyer going to a bank and getting a loan, they instead work out a purchase price, an interest rate, and a loan term with the owner. This has advantages to both the buyer and the seller. Many buyers look for owners to carry back the loan or seller finance because they simply can't get a normal bank to finance them. Maybe their credit's poor, they don't have enough money, all those kinds of things. There are many qualifications a borrower must pass that a traditional bank requires, such as good credit, employment history, debt to income, and a ton of other factors. While other owners may do a credit check or background check, there's no set guidelines and everything can be negotiated. Another advantage is a buyer has to many times put down 20% or more. Most banks require at least 20% down if you're not living in the property. For many investors, that's a lot of money, and they do not plan to live there, so they'll have to at least do that 20% down. The reason why a seller may carry less than 20% down is because they've owned the property for a long time, and they're gonna have to pay a ton of capital gains on the sale. Let's just take an example. Say John has owned a property, it's a 4-unit building for the last 30 years, and now it's worth $500,000. 30 years ago, he bought it for $100,000, and now it's appreciated up to $500,000. He'll have to pay capital gains on the sale of the $500,000, which could be a sizable chunk of money if he does not intend to use a 1031 exchange. Tune into another video on the 1031 exchange and how we've used it many times to save taxes. In a seller finance deal, he can require only 5% down. So let's just say $25,000 instead of $100,000 and hold the remaining note of $475,000. This means he'll have to only pay taxes on the $25,000 and not the whole $500,000. That's gonna be massive savings. The advantage to the buyer is that he or she is only gonna have to put down 25% or 5% of the purchase price as opposed to $100,000, which would be the normal 20% down. So let's say you both agreed to a price and a down payment. The next part is to figure out the length of the loan term, interest rate, and the amortization. Most residential loans are amortized over 30 years, and that is a good starting point, but that doesn't mean that you have to do it for 30 years. Because honestly, most sellers don't want to wait that long to get their money back. Most seller finance loans will have a balloon payment due in 2, 3, or maybe even 5 or 10 years, sometimes even longer. This means that at the end of the 5 or 10 years, whatever balance you owe will either have to be paid off entirely by the seller or you'll have to refinance out. The last part is to figure out the interest rate. This is the rate the seller is going to charge the buyer to finance the remaining loan balance. Many sellers will require at least what the bank's going rates are, sometimes more, sometimes less, depending on what the buyer favors. So in a nutshell, here is how it would go. John agrees to sell Mike this 4-unit property. Now it's worth $500,000 for 10 years, amortized over 30 years at a 5% interest rate. Mike pays John the $25,000 down at closing, and this is the amount that's gonna go directly to John, the seller. Starting the next month, Mike begins making monthly payments to John, which is gonna be $2,550. He can pay him any way he wants. We've even paid some people with Venmo. Even though Mike doesn't pay the entire purchase price up front, he gains ownership day one of the house and can live in it as his primary residence if he chooses. He is responsible for property taxes, insurance, maintenance, just like any other homeowner. To secure a seller's interest in a property, a promissory note and a deed of trust or a mortgage are usually created. These documents outline the terms of the loan and allow the seller to foreclose on the property if Mike defaults on the payments. Now, Mike can buy this investment property without needing a big down payment or perfect credit. He can enjoy home ownership and gradually build equity over time by making payments to John. John sells his house at a desirable price and earns a steady stream of income with interest, which can be an awesome way to earn passive income. He also maintains an interest in the property, making it a very secure investment. And if you've learned anything in this video, remember to like, subscribe, and share. And if you have any questions about seller finance, or if you've even done a seller finance deal yourself and you want to share the details, please leave a comment. And remember, sky's the limit.